mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone, welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some more Ask James questions of the day. First question today is from Brad. He says, you've said before the Fed can lower their short-term rate, but they can't really affect the long-term rates. But now the long-term rates are coming down too. So what does that mean? Brad, that's a great question. And you're absolutely right. The federal funds rate is the rate that they control. By controlling this rate, they determine the interest rate at which they will lend money to banks and the interest rate that banks will pay on deposits. This has a ripple effect, right? It's short term. It affects not only the bank's desire to leave money on deposits with the Fed versus lending it out, but it also affects the interest rate they can afford to pay, which might affect your desire to spend money versus save it, or to maybe invest it as an alternative to keeping it in a savings account. So what about long-term rates? Well, long-term rates are market driven. You're 100% correct. But the Fed can still influence long-term rates. They can't just set long-term rates directly. Now, they haven't done that in this kind of last piece of news, and they haven't indicated that they're even considering it. But, how does the Fed influence long-term rates? They manipulate long-term rates by buying and selling bonds. If the Federal Reserve buys bonds, they increase the demand for bonds, which pushes the price up and the interest rates down. This is what they were doing at the beginning of the pandemic to try and stimulate the economy. Conversely, if they start selling bonds off their balance sheet, just selling them in the open market, they increase the supply of bonds, which drives the price down and increases long-term interest rates. So they've been doing this for, at a gradual rate over 2 years now. That is selling off bonds, right? But at such a gradual rate that it hasn't significantly affected long-term rates. They haven't made any announcements so far about wanting to change this approach. But Brad, you also need to know that long-term rates, because they're market-driven, they started dropping well before the Fed's recent news. So long-term rates began coming down in the maybe second week of August. Why? Because the market anticipated that the Fed's next move would be to lower interest rates. Now, we don't know exactly when, but when short-term rates go down, long-term rates often follow. So the market, being forward-looking, started to push long-term rates down as investors raced to buy bonds to lock in longer-term rates. As a result, the price of bonds went up and the rates went down in advance of the Fed's news. Brad, I hope that helps kind of clarify things for you. And if you have any more questions about investing for income, especially as you approach retirement, always feel free to ask. It's an awesome question. And if you would like to send in your question like Brad did, you can do so by emailing them to poollocke@poollocke.com. Moving right along. Here's our second question. This comes from Tim. He says, I always get confused why bond prices go up when the interest rates go down. Can you explain this relationship? All right, Tim. If bonds are paying less interest now, they should be worth less, right? You would think that. But what you have to realize is that a bond that exists has a fixed rate of interest. So Tim, let's say it's just you and me, right? Let's say I have a bond at 5%, and that bond's going to mature at $10,000 at some point in the future. So you know what you're getting for interest payments, and you know that you're going to get paid the principal when it matures, assuming the bond doesn't default. So mine's an old bond. I've had it for a couple of years, but I want to sell it to you. Now, interest rates have gone down, so the same company that issued my bond will now only pay 4.5% interest. So now you have a choice. You can go directly to the company and get the bond that pays 4.5% interest, or you could buy my bond that pays 5% interest. So you need to think about which bond you would rather buy. And the answer is simple, of course. You'd rather buy mine, right? Because it pays more interest. That means you might be willing to pay a little bit more for mine. And I know, I need to ask more for mine. And if you're going to buy it because my bond is paying a higher interest rate, then you can get today, if you go directly to the company, to understand why there's that inverse relationship between interest rates and bond prices as a general rule. Now that's an oversimplification, by the way, but there's other factors that affect bonds, of course. But so I want to make that clear. One of those components is interest rates, of course. To understand that seesaw type of opposite relationship, you have to realize that bonds that are out there right now have a fixed rate, and they either become more attractive or less attractive based on current interest rates. For example, when the Fed lowered interest rates, a lot of bonds increased in value. Instead of being worth $10,000, maybe they're worth $11,500 because rates came down and those bonds were fixed at a higher rate. Conversely, when the Fed raised rates over the last few years, some of those bonds decreased in value. They might be selling for $9,000 instead of $10,000. Why? Because now you can get higher rates elsewhere. So that's why there's that seesaw, that teeter-totter, if you will, that inverse relationship between bond prices and interest rates. When interest rates go down, existing bonds with higher rates become more valuable. And when interest rates go up, those same bonds become less valuable. Tim, I hope that helps clarify things for you. And if you have any more questions about investing for income, especially as you approach retirement, always feel free to ask. Thanks for the awesome questions today. And as always, if you would like to send in your question, have your question answered by me, you can email it to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. Talk to you soon.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the